Welcome to Inside Economics. I'm Mark Sandy, the Chief Economist of Moody's Analytics. I'm joined by a few of my colleagues, my two trusty co-hosts, Chris Dries and Marissa Di Natale. Hi, guys.
Hey, Mark.
Good morning, Mark.
Good morning. And we've got Matt Collier. Matt, how you doing?
Doing great. How are you, Mark?
The name rolls off the tongue, Matt.
It does.
Beautiful. Beautiful.
Yeah.
It's been a couple years.
I'm
Yeah,
getting
it's
used
taken
to
a
it.
while.
Yeah.
But I got it down, I think. I got it down. So everyone's doing okay?
Yes.
Yeah.
You've been traveling as much as I've been traveling? I've been everywhere this week.
Not this week.
No.
And I had to get up. This is Sarah's fault. She makes me get up at, literally, I got up at 4 a.m. to go to Chicago yesterday. I think it was 5 a.m. to go to New York or DC, and then 5 o'clock in the morning for New York. Sarah, I'm like, look at me. I'm not a young man. What the heck? What's going on? I don't know. No answer from Sarah. She's quiet.
She knows you love it.
I live for it. Anyway, it's good to be back at home and in my suburbs of Philly, ground zero for this election. I'm telling you, it's all going to be determined by my street.
What's the status of the neighborhood? Most up to date, most recent reading?
Everyone's gone quiet. It's gone dark. I don't know how to.
Okay.
I don't know how to interpret that. Everyone's
Maybe
gone for the
because you
bunker.
keep mentioning them on your podcast.
Maybe it. Anyway,
No yard signs?
the yard signs seem to be at a minimum this go around. There are a few.
I agree.
Have you noticed that?
Yes. But I don't know if it's just timing, right? I think that last week, maybe they all come
Could
out.
be.
I know they populate some of our main roads that week, right?
Yeah.
Like
Or it could be
Westchester Pike.
maybe the campaigns themselves don't think they're effective. I don't know. They're spending more money on.
Could
I
be.
saw a billboard. I was on the PA Turnpike, and the Trump campaign is using the billboards. I didn't see Harris on the
Yes.
billboards.
The electronic ones, yeah.
The electronic ones, right?
Yep,
Yeah.
seen that.
But I've seen fewer roadside lawn signs. Yeah, maybe that's strategy. I don't know. But a lot. I mean, have you noticed the advertisements? You try to watch the Eagles game. Geez, Louise! It's just one political advertisement after the next. Incredible. We are ground zero. Okay. Well, let's talk about the economy. Unless you guys want to talk about anything else. Anything else you want to talk about before we get to the economy? The whole chit.
Is there anything else, Mark? Is there anything else?
No, there is never anything else. It's all about the economy. And we got Matt here because we got some new inflation data and some data on consumer spending and GDP revisions too. So a lot going on with the economic data this past week. Matt, you want to give us a bit of a rundown on the data?
Yeah, you refer to it as new inflation data, but it's a familiar story, mostly because the PCE deflator, the inflation data we're talking about, that's the personal consumption expenditure deflator, is the second inflation data point that comes out each month, obviously following the CPI a few weeks earlier. And here it was a relatively predictable but good story. So the PCE deflator rose 0.1% from July to August. That lowered the annual rate, the year-ago rate, from 2.5% to 2.2%, which it's a big improvement. Spike last year in energy prices. Now we look back, we call that favorable base effects. We saw a similar dynamic with the headline CPI. So getting closer and closer. Fed cut by 50 basis points. They're obviously feeling comfortable about it, and this data is consistent with that comfort.
Matt, one factual thing. I was reading your write-up on the deflator. I think it was, or it was your preview. It was yesterday. I was reading it about you were previewing the release today, and you said that the Fed's headline inflation number is the core PCE deflator, consumer expenditure deflator, ex food and energy. I think that the headline is actually the core, is the consumer expenditure deflator, not the core, right? Am I wrong about that? I think so. If you go
It's
look
not
at the
core. It's not core.
They just target PCE.
They just target
Just
PCE.
headline
PCE. And that is a 2%.
I checked that as well recently because people say that. Like,
yeah, all the time.
I've heard it both ways, but I looked back at the Fed papers and stuff. It's headline.
That's
Okay,
their
so
target, their official target in the
Yes.
policy framework, the framework the Fed puts together every so often. says our target is 2% on the consumer expenditure deflator, not the core PCE, the actual PCE deflator.
So for the uninformed or sloppy, I guess, analysts that you referenced that also, like me, that are saying core PC, do you think that's more of a near term? Just we're going to get volatility with energy and food, so maybe that bounces up and down. But core PC is our underlying inflation measure, and that being 2% is kind of a near term target. Or am I trying to salvage my ego here?
I think the latter. You're salvaging your ego.
Well, I also think that
yeah.
I also think that they've always said that 2% is sort of like a medium term target, right? Over the medium term. So they don't need it to be exactly 2% on any particular reading. Sure. They need to see kind of that heading toward that average over the course of, whatever medium term means for them. A few months, 6 months, a year, I don't know. So I think it's a little fuzzy on the 2% itself and when that needs to be reached.
Yeah, just to make you feel better, I got called out on this just a few months ago because I was under the same mistaken impression. It's the core PCE, it's the actual PCE, and someone said no, it's the PCE. I go, no, you got to be wrong, because I always thought it was the core, because the core excludes food and energy, which go up and down and all around. It gives you a better forecast of where inflation is headed. The way you described it was underlying inflation, and that's where inflation is going. But I think if in the official language in the framework document, you should go check and make sure I'm right. I think they're focused on the consumer expenditure deflator, and that, as you said, is 2.2%.
That's right.
So that's within spitting distance of the target, 2%. Now let's go to core though. The core PCE deflator. What did that do?
Also 0.1% from July to August, but the year ago rate for the same, absent the same base effects that headline CPI had or headline PC had, the year ago rate for the core PC ticked up from 2.6 to 2.7%. A little bit of rounding there. But generally watching that and kind of projecting, okay, when is the core PC going to start sliding closer to 2%? I think we see a little bit of that in the next couple months, probably closer to 2.5 by the end of the year. Our forecast has core PC at 2% by the end of next year. That's Fed's latest projections. That's where they were, I think 2.2%. So following what seems to be a pretty predictable trajectory lately, which is certainly a good thing.
You said 0.1, and I know you're in the preview that I read, it was 0.14. So it would be rounded down to 0.1. What do you know what the number is to the second?
I do, and I'm curious
if you're going to significant digit.
I do know the second significant digit, and I'm curious if you're going to ask.
Significant digit. I think we settled on it's the third significant digit.
Okay, I don't know that. I only know the second. Yeah. But the
your ego is getting bruised here badly. I'm just saying.
I'm hanging in there.
Blow number two. Blow number two.
It depends if you ask what the discrepancy is, because it was 0.13, so we were 100 off.
Okay.
I don't know
you get one back. You're getting one back here. That was
all right. Good.
You expected a 0.14 increase on core PCE, and you got a 0.13.
Right.
Very good.
Yeah. So, and that's other forecasters. Everybody was there. We get CPI, we get PPI data. There's a lot less volatility and or errors in forecasting PCE.
Because the CPI data and the producer price index data, the PPI data, are used by the Bureau, the BEA, the Bureau of Economic Analysis, when they construct the PCE. Oh boy, a lot of acronyms there, but
yeah,
the PCE
yeah, exactly. Those are all the important inputs, and we can get a good sense. There's marginal stuff, but seasonal adjustments. But the largely that's the story. So forecasts are pretty accurate. So
okay, so step back. What does this say about inflation broadly?
It's I go back to the Fed's very clear signal when they met. They feel good about inflation. I think they have a hard time envisioning inflation reaccelerating, and that's why they front loaded. They moved quickly, and this report is another data point consistent with that conclusion. So prices are moderating. It's harder and harder to see what would turn that around. I mean, looser financial conditions, people feeling great about what the Fed's done, perhaps, but in terms of the actual underlying components, shelter we look at, we've kind of hand wave that away because of its oddities. When it comes to measuring owner occupied housing, it's less of effect in the PCE deflator than it is the CPI. So you see a minor Minor impact there, even though there was an acceleration. Healthcare, durable goods prices, everything kind of moving as it has been in recent months.
So broadly, you're feeling pretty good about we're if we're not at target, we're close enough and headed in that direction. Right. And anything in the PCE deflator data that surprised you? I mean, probably not, because it was 0.14, 0.13.
Broadly, if I take a step back, goods deflation, I think, has persisted. I thought if prices would have kind of flattened out by now. A lot of that's the vehicle market. Prices keep falling. But it's not dramatic, but it's gone on a few months longer than I would have anticipated. So that's a drag on broader inflation. But that's a minor observation and not totally unsurprising.
Chris, Marissa, anything on the inflation data that you want to call out, or pretty straightforward? Chris?
I'd say pretty straightforward. I think Matt covered it nicely.
Yeah, Marissa?
No, the gap between PCE and CPI has narrowed. It hasn't gotten narrower, but it is more narrow than where we were a year ago, right? When there was a very big difference between the two. It's about half of what it was a year ago. So
what is it exactly? The
0.6.
0.6, which is kind of that's my mind's eye. That's, I think, the kind of the historical
it's
difference.
usually like 0.5. So it's
okay. Okay. So Matt, let's turn to the hard data, the data on the real economy. Got data on consumer spending, income, and of course this I think yesterday we got the so-called GDP revisions, these annual revisions that are revise the data, I think, back 5 years. Correct me if I'm wrong. Is that right, Marissa? It's a 5-year look back
to 2019.
It's 2019.
Yeah.
And you want to talk about that data? Because that usually a lot of times revisions are neither here nor there, but this felt like there was something here. This was important. Do you want to describe what happened here?
Real GDP, the actual most recent quarterly increase wasn't changed, but what's drawn a lot of attention is the upward revision and something called gross domestic income, which is a similar-ish way of measuring GDP, and it typically over periods of time tracks the same way, but there had been a divergence, and it was a matter of which of the two measures, either GDI or GDP, the more familiar, which would be revised towards the other. And what occurred, at least in Q3, is pretty significant upward revision in gross domestic income. Conclusion
in Q2.
I'm sorry, Q2. Conclusion being that, okay, if one of those stories were one story was good, GDP had been churning along, higher than expectations, GDI a bit lower, very familiar, kind of vibe, I guess, if you will, in recent years has been, okay, is it actually as good as the data is saying, or things bad? That's in the job market, that's with GDP. So there's this sense that maybe GDI was telling the truer story, and GDP could have been pulled downward to reflect that. But the opposite happened and kind of strengthened the argument that the U.S. economy is on really solid ground and is expanding well. That was my main takeaway. As far as the older revisions, if there's
can stop there for a second. So just to reiterate, because that's a little confusing. Mm-hmm. So we have real GDP. That's the value of all the things that we produce, and that's based on looking at the consumption side of the accounts, the consumer spending, business investment, what the government is doing on spending, and net trade. And then there's an alternative measure of overall economic activity called gross domestic income, GDI, and that's based on looking at the income generated by the production going on in the economy. So personal income, corporate profits, and a couple of other different things. And these two measures are trying to measure the same thing, but from different angles of the economy, different source data, and they can often diverge. And they have been diverging. More recently, GDP growth has been much stronger than GDI. In fact, I think this is right. Year over year through Q2 of 2024, before these revisions, GDP was 3% year over year, and GDI was closer to 1%, I think. So, and in fact, historically, the thought is that to get a more accurate representation of the reality of what's going on in the economy, you should average those two measures, GDP and GDI. So if you did that, it would say the economy was growing 2%. That's kind of sort of where we were before the revision. Post-revision, the GDP didn't get revised all that much. It's still, I think, 3% year over year. Correct me if I'm wrong, but I think it's still about 3% year over year through Q2 2024. But GDI was revised up big time, big time. And I think it's year over year. I think it's over 3%, 3.5, right? Yeah. So if you average the two, that says growth is over 3%. Real growth, real GDP growth, GDI growth is over 3%. I mean, and the other thing, the revision remember we had 2 quarters of GDP declines back in 2022, and everyone was kind of hand-wringing about recession, technical recession, blah, 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 blah. Well, they revised away a lot of that, and actually there's only 1 quarter of decline, and it's a pretty not modest decline, very small. So the whole thing, it felt like the whole economy, if you now look at the data, the economy has done a lot better since the pandemic hit, and most recently a lot better than the data would suggest. It was already doing well, but now it's doing, dare I say, exceptionally well. So did I get that right, Matt? I know I reiterated what you said just because there was a lot there.
No disagreement for me.
Yeah. Chris, Marissa, anything? What do you think?
Yeah, I mean, GDI for the past 3 quarters is running faster than GDP, right? Which was the opposite of what we had seen prior to those revisions. Yeah, it's pretty remarkable. And then the other big revision is the savings rate.
Yeah, but one more thing I want to say about the GDP before we go to the saving rate, and that is, if the economy grew over 3% year over year through Q2 24, and unemployment rose during that period, I don't know what it is, but maybe 6-7 tenths of a percentage point, which is not inconsequential, and that's all related, to labor supply. Going back to the immigration, all these folks coming into the country, getting asylum, applying for work, going to work, 9-12 months after they, apply. And that's showing up in the labor force. So that you get all this labor force growth, and, their unemployment rates are a little bit higher than the native born. And therefore you get this push up on unemployment. But nonetheless, unemployment is pushed up. What does that imply, Chris, about the economy's potential rate of growth?
It's higher. Right? That's a lot higher.
Okay. What? Pick a number. What do you think it is?
The other point I'd make. Oh, what do I think it is?
Yeah. Based on you can apply so-called Okun's law. Remember Okun's law that relates the change in GDP relative to potential to the change in the unemployment rate. And if you kind of do the simple arithmetic there, and Okun's law, by the way, is a regularity in the economic data that has been there for a long time. And every time the economy diverges from Okun's law, the data gets revised back to Okun's law. So Okun's law, if you do the arithmetic, says potential growth in the economy over the last year has been close to 4%. Close to 4%. It's extraordinary.
Extraordinary,
right?
Yeah.
Exceptional, right? And it makes sense in the context of all the labor force growth given the immigration and also the labor productivity growth, right? We've also seen a surge in labor productivity growth for reasons that are still not, quite clear, right?
Well, that's where I was going, right? So we have this GDP revision upward. We have this labor market revision downward, right? That we saw recently. So Dante,
our colleague Dante,
just saying,
that hurts his argument.
Productivity on the rise here. So.
Talk about a bruised ego, and he's not even here. Yeah,
just preparing him
for because this would mean what you're saying. What upward revisions to the productivity
growth, right? That has to be the case,
right? So all this suggests another reason for the Fed to ease policy, right? I mean, the economy's potential is rip-roaring, and if you're holding back the economy, given that fast potential rate of growth, you're going to get rising unemployment for no good reason, because you're not going to get inflation as a result of the strong growth, right? So there's just another, a screaming reason why the Fed should normalize interest rates here as fast as possible. Given now, I don't think the economy's underlying potential rate of growth is going to sustain at 4%. I'm not arguing that, because already immigration is starting to slow, given President Biden's executive order, and that's slowed down the amount of asylum seekers coming across the border. And I can't imagine productivity growth staying at this pace. But nonetheless, nonetheless, pretty extraordinary, right? Marissa, anything on that point before we go to the personal saving rate? Because that's another really important thing.
The labor force portion of it.
We'll get back to the personal saving rate, but on this,
yeah.
Anything you want to say about that before we move on?
No, I don't think so. I mean, I think you're right. We know from border crossing data that immigration has dropped off about 50% from where it was, encounters at the border, the latest data that we have compared to earlier in the year. So it's not sustainable. And given the both presidential candidates' proposals on immigration, it's unlikely that we'll see any sort of bounce back anytime soon.
Although one's got a very different perspective on that than the other, right?
Yes, but
I wouldn't equate the two.
Either way, we're not going to see the immigration that we saw over the past couple of years.
Right. Which I think everyone would say that's probably a good thing. We don't.
Right.
Well, yeah. Right. But bottom line, the economy's. Can I say rip roaring? It's rip roaring, right? No, come on.
Could the counter be though?
2023. It's rip roaring in 2024. No. Anyone?
Yes. And then the question is, what's 2025? Right.
Okay. All right. Let's go to then. Okay. In that regard, let's go to the other revision that you were bringing up, Marissa, earlier, the personal saving rate. Describe what happened there.
So that was revised significantly higher. So the personal saving rate, if you recall, we talked about it a few times, and that had fallen down into the low 3% range over the past year or so. And this too, with these revisions back to 2019, was revised higher. So now you're seeing an average savings rate that's up around 5%, as opposed to 3%. So that, could suggest that either spending has not been as strong, or spending will slow more, or people just have a lot of cash, which was also backed up by the data that we got the other day from the Consumer Expenditure Survey.
Just to stop, maybe I'm wrong, but the revision up, I don't think it's because there's less consumer spending, right? Because it's the income that goes back to GDI. The income we got a lot more income, right?
That's
yeah. Okay.
True. Yes.
Okay. So the saving rate, we had been observing it. It was kind of in the. Correct me if I'm wrong. I think it got below 3 last month in the pre-revised data. I think we got to 2.9% in August. And, just for context, pre-pandemic, the personal saving rate was 6.5%. And we kind of take that as, I'll call it the equilibrium saving rate, kind of, when everything is kind of where it should be for consumers and the economy, interest rates, everything else, it's about 6.5%. And we had seen it come way down and now falling below 3. And with this revision to the income data and the GDI, it revised up the personal saving rate. Now we're closer to 5. So it's not quite back to the 6.5. But it 5 is a big difference than 5 and rising as opposed to 3 and falling.
Right.
Is a big difference.
Yeah.
Right. And that would argue, what does that say about consumer future going to Chris's point about 2025? What does that mean for growth going into 2025? Marissa?
I mean,
I don't mean this to sound like a high school. This is a college econ test. I'm sorry about that, but just to state it, what does it mean, Marissa?
Well, I mean, it could mean that spending is more constrained if people are saving more money, right?
No, it means they got more firepower. What they're spending. The spending is strong. We're getting 3% GDP growth. What it means, in my mind, is it means that they have more financial firepower going into 2025 so that they can spend. They don't.
Yes, I mean, I think it has meant that, but what's the direction of the savings rate? If savings keeps rising, people are saving more. Could it be that they're not spending as much, or they're more worried about their finances?
Agreed. But it's one thing if you're at 3 and you have to get back to 6.5 if that's equilibrium. It's another thing if it's 5 and you have to get back to 6.5. That's a totally different ballgame. And and it just means relative to what we thought, the consumer is in a much better financial spot. They have more saving. The saving rate's higher. they're in a better financial spot, so they don't need to be less likely. They're going to be more cautious next year, or put it this way, as cautious as they would have been otherwise. That augurs well for consumer spending in the broader economy in 2025. Chris, do you disagree with what I do?
I'd say the only wrinkle to that argument is the distributional part of it, right? I think much of that saving is still going towards the middle upper end of the income distribution. So there are differences there. That lower end consumer, I think, is certainly seeing an improvement in their financial condition, but they are the ones that will probably have to rebuild their savings to a larger degree than the other parts of the distribution, right? So they may be pulling back on their spending going forward. They may not have quite that impact that you're referring to.
Yeah, no doubt. I mean, the bulk of the saving is in the folks at all times is in the folks in the top part of the distribution of income, the kind of the top third. Actually, we do calculate saving rates by income based on survey of consumer finance data and financial account data from the Fed. So it's a little bit different than this data we're talking about right now. It's trying to measure the same thing, but from a different angle, looking at changes in the value of assets and liabilities held by, the household sector. And it does show that the folks in the top, that's where the bulk of the saving is. And that's where the so-called excess saving is still, the saving that was built up during the pandemic. And there's still plenty there, which augurs well. And it's the folks in the top third that, kind of drive the train, right? Because they account for typically, based on consumer expenditure survey data, 55% of the spending. So they kind of drive the train. Interestingly, in that data, it's the folks that are kind of a high middle, kind of the 60 to 80% of the percentile of the distribution, kind of just above the middle part of the distribution, where they've drawn down the saving the most. That's where the excess saving has been drawn down the most, which is interesting. I'm not sure how much to read into it, and that's why you kind of did the shimmy there.
Yes, you saw the shimmy. Right. It was very subtle.
A little subtle. I saw this. I saw the shimmy.
Yeah,
I saw the shimmy. Okay,
but
but my broader point, though, Chris, do you agree with what I'm saying here in terms of, compared to where we were before the revision and are thinking about the consumer is in a better spot. Yes, the low income consumer has to repair their balance sheet, but broadly speaking, you got to feel better about the consumer, no? Going into 2025?
Yes, the balance sheet is better than what we had seen previously. So that's clear. I guess that, we also got some real personal spending data over the last couple of days, right? We had a little bit of a deceleration in August relative to earlier. So it does seem as though consumers may be pulling back a bit on their spending, right? So we have to also adjust what is their ultimate target in terms of the spending they would like to get back to, right? So it could still be the case that their balance sheet has improved, but they still want to save a bit more, and therefore they're going to pull back on their spending.
Well, in fact, that's our forecast, right?
Exactly.
You look at our forecast, we have growth slowing back down to 2%. And that happens because consumers are more, particularly high-end consumers, but also low-end consumers, low-income consumers are more cautious. They don't cut spending; they just don't increase it quite as fast.
Exactly. I'm just tempering your rip roaring comment. That's all.
Yeah, it feels like we got to revise up our growth rates for next year. Given what's happening here. I mean, it may be higher than 2%. It might be. Maybe it's going to be closer to 2.5% because we're growing 3%. We're growing 3%. Anyway, okay. So here's the thing. I'm looking at all this data. GDP 3%, GDI 3.5%, unemployment 4.2%, solid job growth. It's slowing, but that's it's by design. No layoffs. Record stock market. Record housing values. Interest rates, huh?
Price of gas.
Price of gas coming in $3. What is it now? $3 at the local.
I saw $3.20 yesterday.
Okay, $3.20. Okay, that's got to feel good. Inflation, we just talked about. Back in the bottle, so to speak. What this economy is? I'm going to just say it. Unbelievably good. No. unbelievable. I mean, of course, there's pockets. There's, it's a big economy. It's a big elephant. And it depends on where you touch the elephant. But you look at the elephant, the economic elephant. It's like, really, have you seen a time in your career when things are as good as they are today? I'm just asking. I mean, I've been around for a long time, 30, 35 years, and I'm having a hard time saying, yeah, I find that there's an economy that's better than this economy. No?
1999.
What, August 3rd, 1999? So, okay, 1999. I disagree, because that was.
You think it was worse?
Huh?
You think it was not as strong back then?
No, I think it was being juiced by a massive bubble in the equity market.
Yes, that is true, but it felt good.
No. But I'm saying fundamentally,
yeah,
fundamentally, this is the best economy that you've ever experienced. Chris, can come up with another date? No, got to think about it.
No, I'm thinking about it. And like the housing boom.
I am telling you, in the 35, 40 years that I've been watching this economy, maybe there, we've got to think about it more deeply, but I'm hard pressed to find a time when things are better than they are today. Really, by objectively looking at the economic data. Yeah. Okay. Well, think about that. Okay. Let's change subjects a little bit. Did you see that Wall Street Journal opinion piece about, my forecast prowess? Did you guys catch that?
Oh, was there a piece?
And I'll have to say, I've kind of ignored it because, I thought it was not worthy of spending much energy and time on it. So I didn't really read it that carefully. So maybe, Chris, can you summarize what it said in a nice way? Unlike Matt, my ego's fragile. I have a fragile ego. I'll admit it. Matt's got a tough ego. I've got a fragile ego. But go ahead.
It's less tough now. But sorry,
less tough now. Yeah, less tough now. Right. What did it say?
Well, ostensibly, I guess from the title, it was a piece that was directed towards your election forecast, right? It was saying that the Trump campaign has nothing to worry about because you, Mark Sandy, were based on your election model forecasting that Harris would win, right? So that was the leading thesis. That was the title. That's what I thought I was going to get, and I thought it was going to be, they're going to go back and look at all of our election predictions, and
yeah, right.
There was the miss, of course, with Clinton versus Trump, right? That was a miss of the election model, but pretty good track record before that, right? And I thought that was what the piece was going to be about. But then the author started to review all of your forecasts, right? All of the economic forecasts historically, and I would argue there's quite a bit of cherry picking that went on in that review, right? Which was brought up just various forecasts. And you make thousands of forecasts, of course,
right?
Continuously. So yeah, pretty easy to find some where you were wrong, where the economy did turn out differently. I also thought the piece lacked some of the context, right, that these forecasts require. You're making forecasts at a point in time based on available information. That doesn't mean that that's how the economy is going to play out if other factors come into play, right, and kind of take the economy off course. So it's fair to review every forecast and back test, of course, but the piece seemed to me to really be a dig at all of your forecasts to kind of discredit the election forecast. I think that was
discredit the
election piece.
The election, or discredit more fundamentally me. No, don't you think?
To me, I think that was the device to really underscore.
Saying don't listen to this guy because he gets all the forecasts wrong.
But really about the election, right? It was kind of tying back to the election.
Oh, interesting.
That's how I interpret it. Marissa, just using all the other forecasts as a way to demonstrate or support the argument.
Right.
I did like the little Easter egg in the art. I don't know.
I missed that in my skimming. The
Easter egg I saw was that she made a comparison to Punxsutawney Phil.
Oh, I love Punxsutawney Phil.
love Buck's, and we all know, all the listeners to the podcast know that Groundhog Day is your favorite movie. So I thought that was a very
that's right.
clever, very endearing Easter egg that the author intentionally inserted there.
So. Oh yeah.
So you think that was an olive branch, Chris? You think I didn't pick up on it that way. Okay.
Well, clearly it was doing the research, right? Deep research. So I figured, that must be the tie-in here. So.
That's funny. Marissa, do you have any other takeaway? Did you read the piece? I'm sure.
I did. Yeah.
Did you underline it, yellow highlight, that kind of stuff, or no?
No, I did not enjoy reading it, Mark. Made me not happy. Yeah, I mean, I think she just, my thing reading it was like, why you? Why is she going after you? And I think the reason is because you have an election model, right? And she doesn't like the fact that you're saying that Kamala Harris is going to win. So therefore, let's go back through this guy's history and let's cherry pick all these times he was quote unquote wrong. And therefore you can't believe his election model. Yeah. I mean, you could do that with any professional economist, go back through their history, cherry pick things that they got wrong. It was quite unfair and obviously politically motivated.
Thank you for that. I appreciate that. My wife and relatives and friends said pretty much the same thing. So that was very kind. I'll have to say a couple things. One, I don't tend to read those kinds of things. I mean, there's been other stories like that in the past, and I tend not to, because you can't get wrapped up in that stuff. I clearly hit a nerve, maybe more than one, probably a few nerves. And I made someone angry, and I suspect that journalist did not write the piece. I think it was placed, someone else wrote the piece and, gave it. I can't imagine she did that research. That was one thought. The other thought was, I was actually kind of flattered. Is that weird to feel flattered? I mean, that must mean that what I'm saying has like an impact. Otherwise, why would you write the piece? Right?
Yeah.
I mean,
right.
Actually someone sent it to me early in the morning and I'm looking at it and I go, this is probably some third-rate kind of media, off some website in the dark web. I don't know. And then I see the kind of the opinion logo and I go, that looks like the Wall Street Journal. That can't be the Wall Street. No way could that be the Wall Street Journal. So I click on it. It's the Wall Street Journal. So shouldn't that, I mean, I'm going, I feel kind of flattered by this. This is kind of cool. And then the third thing that hit me goes, the irony of it is that one of the best forecast calls I've ever made just happened. It goes to this great economy. I mean, the entire world was saying, nearly the entire world, almost every economist, every CEO, almost everybody's saying we're going into recession in 2023.
Right.
We're going into recession. And I'm sitting there, yield curve is inverted. That never is wrong, blah, blah, blah. And I'm saying, no, clearly the risks are high. History would suggest when the Fed's jacking up interest rates, you've got a higher risk. But we never had a recession in our forecast. Never had a recession in our forecast. In fact, we've underestimated the growth that's occurred, since then. So I'm thinking, of all, I mean, that seems to be the key. Economists predict lots of things. We do a lot of forecasts. I mean, of course, you said thousands. In my career, I've probably done tens of thousands of forecasts, right? You have to update them all the time, every day. But the key ones that matter the most are turning points in the economy. When the economy is turning up or it's turning down. And I would say, take a look. I feel pretty good about my track record. And this last one is well documented. You can go take a look and see. So I thought, wow, that's really weird. I mean, I actually felt pretty good about my forecasting, and here they're digging at my forecasting. So, and then I go, the election model. Finally, the final thing I'll say, I'm actually feeling pretty good about that election model. I'll have to tell you, that election model says this election is going to be won by Kamala Harris, and it's going to boil down to PA. The state of Pennsylvania the state that we live in. And, I'm feeling pretty good about that at the point in time. Obviously there's, I don't know, 6 weeks to go here. Things happen. But if you look at the, all the betting markets and the polling and the economic data, if that's the number one issue for Americans, I know many Americans still feel the sting of the inflation and the higher prices, back a couple, 3 years ago, and why there's this disconnect between the happy talk of economists like me and the American people. I get it. I understand it. It makes sense. But at the end of the day, the economy is objectively as good as I've ever seen it. And that ultimately, I think, will shine through. Anyway, that's what I have to say on the subject.
Has there been any fallout of this? You didn't know this was coming, I assume.
I had no idea.
Okay.
No fallout. No. In fact, I think I probably will call undue attention to it now with the podcast. But up to this point, there's been no. As far as I can tell, according to Sarah, who monitors these things, there's been very little attention paid to it. So.
Can I just say two more things about it? One, just about the forecasts. The irony of it was that your election model has actually been incredibly accurate since 1990. I mean, there's only been one miss. So the whole premise of the article was, we can't believe this election model because Mark Zandi's always wrong. But yet that's been one of the most accurate things you forecast, which she didn't mention. She also called out the house price forecast back in 2005, 2006, right, as one of the things you got wrong. But correct me if I'm wrong, but my recollection of that was that, you were wrong about the magnitude of the decline in house prices. But I think you were one of the only economists saying that house prices nationally in aggregate we're either not going to grow or we're going to fall, right? No, very few, maybe like Nouriel Roubini, because everything's terrible, right, in his forecasting world. But other than that, I don't remember anybody else saying nationally house prices were going to decline.
I'm actually very proud of our house price forecast back in the period. We've got a paper that we wrote saying prices are going to fall, and it was a modest decline, I think, in the single digit decline. This was back in late 06 or 07, somewhere in that period, before prices actually started to decline. Well before they started declining was 06. And to say that national house prices were going to decline was, Chris, because you were Fannie Mae at the time. To say that was like you're out of your mind. That never happens. Maybe you get a price declines in Texas when the oil price busts, but a national house price decline, not possible. Not right? Am I wrong, Chris?
No, you're right. I recall at the time the stress test was assuming that 2 major regions in the U.S. would have house price declines because historically, you had one, right? It might have been Texas, it might have been California at different points, but you never had a national, coast to coast decline. So it was that forecast made a splash, certainly.
Yeah. Okay. Anyway, this was a lot of fun. I appreciate the kind words. Thank you.
Can I make? I think you should take it in this.
I think you should take it in the spirit of a celebrity roast. Right?
Oh, okay. I like that too. I'll take that. Matt, you were going to say something?
I already showed you a little appreciation of your Twitter response. I thought that was good, and it deserves some kind of call out. You held up in a triumphant Punxsutawney Phil was being held up Groundhog's Day, and that was the tweet with.
I think 3 people in the world understood that tweet, and you were one of them. I was happy. Here's the funniest thing. The funniest thing about that, Sarah. I keep talking about Sarah because Sarah's like critical to everything. Sarah tweet writes back. She goes, "Did you get help with that tweet?" Because there's like zero probability that I could come up with that tweet. You're right. I did not come up with the tweet. It was my daughter who came up with the tweet.
That's good.
Yeah.
Yeah, it was sharp. I hit up Sarah and I said, "Great job helping out Mark with that shit." I had nothing to do with it.
That's so funny.
Yeah.
That is so funny. Anyway, let's move on. Let's play the you want to play the game? You want to play the stats game? Let's play the stats game. We each put forward a statistic. The rest of the group tries to figure that out through clues, deductive reasoning, questions. And the best stat is one that's not so easy. We get it immediately. One that's not so hard, we never get it. And if it's apropos to the topic at hand, all the better. I'm not sure what that topic is. Oh, the exceptional economy, I'd say, is the topic at hand. All the better. Marissa, as tradition has it, you're up.
Okay. 225,000.
It's not UI claims, is it? 4-week moving average?
Yeah, you got it.
Oh, nice.
Oh,
Yeah, that's it.
okay. I just want to say, Chris,
See, folks.
do you see how that's done?
Nicely done. Nicely done.
Anyway, that's an inside joke.
That's the 4-week moving average of UI claims. Latest read on UI claims from the week ending September 21st, in line with this theme of an exceptional economy, right? UI claims have now been falling since they peaked in the summer, and they're kind of back down to this very low sub 220 a month, 220 a week level. So still no evidence that, even though we have the unemployment rate is elevated from where it was a year ago, it's totally a supply side phenomenon. We don't see layoffs in the economy. I'm feeling increasingly good about the job market.
Marissa, if I said to you, Marissa, what is the number of UI claims you would say is perfect? What would be the perfect number of UI claims? What would you say it is?
I mean, it feels pretty good where we're at right now.
I would have answered 225,000.
Yeah. I
Right?
mean, right around, this is like, remember before UI claims started rising in the summer, they were like 220 every month.
Yeah.
Right around there, within a few thousand up or down. And the unemployment rate was inching higher, but I mean, it was still right around 4% where it is today. So
yeah, I mean, again,
they're quite low.
back to this is the best economy I've ever seen.
Yeah.
That is literally the number. If you had asked me that question, Mark, how many UI claims would be consistent with an exceptional economy? Perfect. Right exactly where you want to see them. What would that number be? I would say 225,000.
Mm-hmm.
And that's what it is. Right?
Yep.
Yeah. No layoffs. Amazing. Chris, you're up.
2.96%.
That sounds like a GDP related number.
It does indeed.
It is related. The GDP report.
GDP report.
Is it consumer spending?
No.
Is it the 2024 Q2 annualized growth rate for something in the GDP accounts? Or is it the year over year?
It is a percent change quarter to quarter.
Oh, it's a percent change quarter to quarter, 2.96. Matt, you know what that would be?
Investment related?
No.
Is it nominal? No. Something nominal related? Is it not real? Or is it nominal growth?
It is nominal.
Oh, nominal growth?
Yeah.
That doesn't help though.
No.
So it's a component of GDP.
It's not a component of
corporate profits grew 2.9%. Okay,
Beautiful.
Marissa.
Mark, amazing. Way to come back to that Wall Street Journal article.
Was that before or after tax?
The listener thinks you guys are easy on me and feeding me these answers. That is not what's happening here. No.
Clearly, no, it's not.
Yeah.
Before or after tax, Mark?
I don't know, but I'd say before tax because that's what you'd probably go with, before tax.
Nope, after tax.
Oh, it's after tax? Okay. Oh, geez. Bummer.
Before was 3.17. So.
Oh, okay. Okay, very good.
Pretty close.
Oh, okay, so talk about corporate profits. Did they get revised up? I didn't even look. Do you know?
Oh, I didn't look for revisions.
I'm curious.
Here. I should have, but I don't know.
I would suspect yes, but yeah, I would look.
Probably would be my guess, but
probably, yeah.
But yeah, 2.96 remains it's a healthy profit growth rate. It's above average, and I chose this for a couple of reasons. One, it's we still have healthy corporate profits, and yet inflation is moderating here, right? So kind of going back to that price gouging argument, you can have kind of a healthy corporate sector and inflation coming in. So that was one of the main reasons I chose this. The other, just we do want corporations to remain healthy. We don't want them to fall apart, and this suggests that they are continuing to deliver, and that should be favorable for the economic growth going forward, favorable to the labor market if they're not feeling quite the pinch, right? Certainly on the profitability, that should all augur well for continued growth here.
Yeah, I mean, I think that goes back to the layoffs, right? I mean, if businesses are profitable, making money, then they're under less pressure if there's something doesn't stick exactly to script to lay off workers, right? So, I mean, I think one reason why we're seeing exceptionally low layoffs is we're seeing really good profitability, really good profitability. And this also goes back to the productivity growth, right?
Yeah.
I mean, because you can get, and if you have strong productivity growth, that offsets your labor costs, the wages, the growth in wages, so you can maintain your margins, and everyone benefits, right? You can pay your workers more, and you still get more profits. Stock market at a record high, so another reason to think, another data point that says best economy ever, right? I mean, feels pretty good.
Yeah.
Okay. Can I ask? I don't know if you dug any deeper. But when I look at profitability, sometimes I go look at non-financial corporate, profits. I throw out the financial sector because that goes up and down and all around. How did that look?
I did not look at that.
You did not look. Okay, no worries at all. Okay, Matt, you want to go next?
Yeah, going back, corporate profits were revised up, so they do look better now.
Okay.
And I think Dante's in trouble because, like, if the economy's potential growth rate is way up, I think that profit story really does point to the productivity side of it more than the labor force growth, as we can tell right now. I mean, it's fast in real time, but it's tough to tell in real time. My number is 12.6.
I know what that is, and you guys are going to be so amazingly impressed. And no one's feeding me this. I just know what this is. It's the labor market differential in the Conference Board Confidence Survey.
That's right. I'm surprised.
Okay.
Yeah.
Okay. Come on.
Wow.
Bow down. I am
Wow.
like on fire here. No?
Yeah.
That editorial really injected.
Something happened that light a fire under you to be very motivated.
I'm motivated, baby. This is great.
Yes, that's right. So just to clarify, it's the Conference Board Consumer Confidence Survey. The survey asks people what they think about the labor market. So are jobs easy to get, in your opinion, or are they hard to get, hard to find? Take the difference between the two. And 12.6 is the lowest. You ignore pandemic wackiness. It's the lowest since 2017. So kind of an indication or suggestive that the labor market is cooling. I don't put a ton of stock in it. I think it is something that people can point to say, the labor market's trending downwards or is softening too much. But yeah, at least a little bit of evidence for those who are concerned about the labor market.
Well, I looked at that, and it makes me a little nervous. But the thing that made me most nervous is the Conference Board survey, the top line confidence index. Still, I think it was 98.7, right? I think that was the read.
That's right.
For the month of August. It's still very consistent with the long run average. I look at that measure of confidence very closely. I think that's a very good leading indicator of the economy's movements in consumer spending and ultimately the economy. It's a good leading indicator of recession. When that starts falling dramatically for a couple, 3 months, 5-10 points, that signals that consumers are kind of losing faith. They're getting nervous. They're going to pull back. And, that's when you get layoffs and go into recession. So 98.7 is right around the long run historical average. And when I say long run, that survey's been around since the 70s. So we've got a lot of data points. So it's okay. But that fell in August compared to July. In July, it was like 105.3, if memory serves. It can move, but that was a pretty big decline, particularly given that I expect it to actually increase because, it's the best economy ever. Gas prices are down. Gas prices tend to really have a big impact on consumer sentiment and confidence. And they fell pretty sharply in the month of August. And I expected that to push up the Conference Board, but the labor market seems like it might be a little more squishy than I thought, and that brought down the number. So, what do you think about all that, Matt? Is that worrisome to you?
I know you've relied on the Conference Board Consumer Survey as and dismiss University of Michigan, frankly, because it's just been so low and people have been so downbeat for so long, that it's difficult to really make sense of it, or it's easy to discount. I still, this is a sentiment survey, and I tend to think that it's not, if you see UI claims running at 225, as Marissa alluded to, I don't know how squishy the job market can be. I tend to just take anything sentiment related with a grain of salt, even this measure. It's people's impressions of the job market. They haven't been laid off. Hiring is still okay. They're still spending. So I think I'm just committed to not moving off of anything until I see it start to show up in hard data like UI claims or consistent weak monthly job growth.
Yeah. Okay. So you kind of downweight this as a measure to look at.
Yeah. I mean, best economy in your career as a professional economist, then it's at 98.7, which is mediocre, okay economy. So there's just a gap there that I think it's just a dissonance that I have a hard time.
Yeah. Okay. Okay. Marissa, I mean, that 12.6 on the labor market differential, lowest that has been since, I think Matt, you said March of 2021. Worried about that at all, or not so much?
No, I definitely took note of it. Both things can be true. We don't have layoffs, but we know that hiring has softened quite a bit. So people could be perceiving that it is harder to find a job because employers just aren't hiring, right? It doesn't necessarily mean that they're going to be laying people off soon. I'm not worried. I'm not worried about the number, but it's notable. And it could also be what people's perception, what people have gotten used to over the past few years, right? I mean, we've gone from an economy where we were adding 500,000 jobs a month to one that's now adding 150,000 jobs a month. So it could just be sort of that disconnect in like where the economy was or the job market specifically was a few years ago, compared to where it is now. And it's just sort of that expectation gap.
Yeah. I get the other thing that I get a little correct me if I'm wrong, Matt, but I think if you look at the average of the labor market differential throughout the history of the Conference Board over the period over which they've been asking this question, the average is actually zero, or actually maybe even on the south side of zero a little bit. So
yeah, I don't have that exact, but I was same conclusion. Like it's still an expanding economy.
Yeah, I mean, so an economy kind of in equilibrium is one where the market's not tight, it's not weak, it's zero, and so we're still on the high side of zero. So I took some solace in that. Okay, well, I thought we would end the conversation going back to the election, because that's coming up here pretty quickly. We're 6 weeks away, and the candidates, Harris, Trump, are out on the campaign trail and putting out a lot of economic policy. Obviously, the economy is number one in the voters' minds, and key to the election. And I just wanted to ask, because there's a blizzard of things that are being put forward and that are being said. Are there anything that you have heard recently that you want to call out in terms of policy, or it gives some sense of what the candidates think about economic policy? Anything out there that I'll go around the horn. Chris, anything that you noticed in the policy?
All the tariff chatter.
All the tariff chatter.
Yeah. Somewhat disturbing to me. The latest proposal I heard was a 200% tariff on John Deere's imports into the country. Right,
This is former President Trump, right?
Correct. Yeah. John Deere, of course, a large U.S.-based agricultural machinery manufacturer. They are intending to move have moved some of their production down to Mexico because of cost differentials, and they're focusing more on the higher end of the production line in the U.S., right? So specialization, kind of the classic story around economic motivation. But a 200% tariff on those imports, I think, is going to be pretty devastating, right? And I know the intent is to then keep that work in the U.S., but it may ultimately lead us to losing that production altogether. John Deere may not be able to sustain that production in the US, and therefore it just goes overseas to some other company, not a US-based company. So I worry about all these proposals here to really try to engineer a result in the economy that ignores comparative advantage and all of the thinking around free and open trade here.
Yeah, you make a great point. I mean, when we talk about tariffs, economists hate tariffs. I mean, you put 100 economists in a room, 97 will tell you they don't like them. The other three, I'm not sure I can't tell you who they are, but I'm sure you'll find three. But the one, and everyone's focused obviously on the obvious, and that is it's just a tax on consumers. It's going to jack up the prices for things that are imported, and it's going to, particularly on low income, middle income households, are going to have to pay more. But the thing that I don't think gets enough appreciation, and that your John Deere example kind of strikes that point home, is they're very capricious, right?
Yeah.
I mean, it's crony capitalism at its worst, where, because if you go back to the tariffs under President Trump's first term, they set up, I think, some kind of, I would say board, that might be not the right word, but a group of government officials who decided, well, which companies had to bear the tariffs, which products, which goods, which countries, over what period of time. You make all those choices. That, and it's not transparent. It's not clear. That leads to, I think, generally a lot of uncertainty with regard to global trade, and it just raises the cost of doing business, and ultimately, it causes trade to break down and does a lot more damage in the long run, as a result. So it's not just about the tariffs themselves; it's about how you implement them, and there's no good way of implementing it. It's a very messy thing. And this John Deere example is a great example of that.
Yeah, that's absolutely right. And we could think about, we want to protect smaller manufacturers or help smaller manufacturers, and then once those tariffs come into effect, then all of a sudden we discover, there's a critical intermediate component that you need. And,
right.
hey, let's create an exception for that, and let's create another exception over here, and then it becomes a real mess to try to understand what the impacts are. And then on top of that, it's a very dynamic system as well. There's going to be retaliation, right? So it's hard to think 7 steps ahead to really understand what the impact of these tariffs. But at the end of the day, our history has shown that they often backfire. They don't achieve the goals that they set out to do, or they become so complex that they fall under their own weight.
That's a good one. Hey, Marissa, you hear anything on the campaign trail you want to call out?
Tariffs is the one that bothers me the most. The immigration talk from the Trump campaign as well, I think, would be very detrimental to the economy.
Deportations, you mean?
Yes. Yeah.
Yeah. I mean, you hear people push back on that and saying, "Oh, there's no way they're going to deport, lots of immigrants in out of the country. Practically, you can't do that. It's just talk." What do you think of that?
I mean, I think former President Trump tends to do things that he says he's going to do. He may not get exactly what he wants, but he will certainly try to do it. So there's probably some kernel of reality in that. But it's also what that does to the sort of perception of immigration into the country, right? If immigrants think that this is going to be a very hostile place to be, then they will not even attempt to come or try to come. Some will voluntarily leave. We saw that back in 2017. So just given what we know about demographics in this country, we know that we're going to be totally reliant in 15 years on immigration to fuel population growth here. So just taking that out of the equation will be very detrimental to US growth. Now, I'm not arguing that the immigration surge we saw over the last couple of years is what we want or is healthy or was well controlled at all. But to sort of, put these very high barriers up to immigration at a time when we really need this to fuel growth is bad economic policy.
Yeah. Okay. Hey, Matt, anything you noticed on the campaign trail you want to call out?
Either this week or last, Trump campaign mentioned influencing or capping interest rates that credit card companies are charging.
Right.
So if 97 out of 100 economists hate tariffs, I think more would hate that. So is it just campaign bloviating maybe, but that's the kind of thing where it's just to game it out. It's like, okay, then if you're a credit card lender, who are you lending to? Only the prime, assuming these interest rates are artificially low. It just cuts out so much credit. Costs go way up. Just a really silly, unworkable policy, bad policy.
Yeah, interesting. Yeah, I think there is. I'm really curious to see with the Fed rate cuts how quickly credit card rates start to come in, because the spread or the difference between credit card rates and the cost of funds for banks, the credit card companies, is very wide. I think it's historically wide, and really, would be interested. Can't wait to see what happens here. I mean, it's really important that they start to come in, particularly going back to low income consumers who took on a lot of credit card debt to supplement their income when inflation was strong. They need that relief, but I'm a little nervous that there isn't enough competition in that market to bring down those rates. Now, I'm not at all arguing rate caps. I think that makes no sense whatsoever. It's like, on the price gouging debate, that's a pretty vexed way of, trying to address higher prices, in the wake of a crisis. But nonetheless, I think it's worth, paying close attention to. Okay, I was going to call out, the three of you talked about it. Trump, VP Harris did give a speech recently and talked about tax subsidies to the manufacturing base. And I'll have to say, historically, I've been kind of queasy about, kind of targeting tax policy to help one sector specifically over another. But in the context of our vexed relationship with China, in which is resulting in, I think this is an hyperbole, it's changing our business model. I mean, I think historically, before the last several years, we viewed China as kind of our manufacturing base. That the quid pro, we would invest in their manufacturing, they would produce cheaply and send it back to here, and we would send them they would buy our technology and send their kids to our schools, and we'd have this kind of very symbiotic kind of trading relationship. But it's clear that that's not working, and so we can't rely on China for manufactured goods. And so I'm increasingly of the mind that for national security issues, we need more manufacturing here, and subsidizing, at least for a while, subsidizing, investment in manufacturing here in the U.S. is probably a pretty good idea in the context of that national security risk. What do you think of that argument? Does that resonate, Chris, with you? Are you more skeptical?
Yeah. Certainly there are key industries that I understand we need to have a capacity to produce, but I'd rather see us again kind of focus more of that effort towards freer trade with other countries, right? So build up, additional trading partners who could replace China, right? Maybe more friendlier countries, more closer to home, not necessarily try to artificially force an outcome within the U.S. If it's going to be very costly, very inefficient, right? I think we need to think more broadly.
Yeah, I think I use the word incent as opposed to artificially force, but I guess that depends on
it depends how big, if the incentive.
Yeah, it depends.
I guess my point is, if the incentive is so large, you're really forcing an outcome, right? Then the economy really doesn't support that.
It's not sustainable.
That outcome, and you're really, forcing it. Right.
Okay, well, why don't we, between now and Election Day, in these podcasts, we'll do the same thing. We'll listen carefully to what the candidates are saying and call, and maybe they won't say anything and we won't do it, but let's do this. I think this is useful, to kind of call out things that the candidates are saying and have a discussion around it. Okay, I think we're long in the tooth, as I want to say. I think we should call this a podcast. I do want to say, hey, listener, keep bringing those questions. If you got questions for us, we would be very happy to answer them. I think it makes for a useful conversation, and we'd love to get those questions. So if you've got questions, concerns, anything you want to talk about, fire away, and we'll talk about them in future podcasts. Okay, guys, anything else before we call it a podcast?
Yeah, you can send those questions to helpeconomy@moodys.com.
Thank you. I would never I always forget that. Yeah. Okay. Okay, Marissa, Matt, anything? No.
Make them good questions.
Make them good questions. Absolutely. Goes without saying. Okay. Good. All right, dear listener. Thanks so much for tuning in. I hope you enjoyed the podcast, and we will talk to you next week. Take care now.